man.
So today we are attempting something pretty ambitious for you all listening.
Yeah, very ambitious.
We are trying to take a snapshot of a completely moving target. We're looking at the economic and political landscape of 2026. And let me tell you, I have spent the last 48 hours just buried under this mountain of financial reports.
Oh, I believe it.
Yeah. Transcripts of political speeches that went on for hours, market analyses from everywhere. And the picture that is emerging for us right now is a world of just extreme contradictions.
It really is. I mean, if you just glance at the headlines right now, you might get whiplash.
Totally.
On one hand, you have record-breaking highs in Asian markets, absolute euphoria over there. And you have a U.S. administration declaring a literal golden age.
Right.
But then you scratch the surface just a millimeter, and there is this constant hum of anxiety. It's what the traders are calling the AI scare trade.
The AI scare trade.
Yeah, the fear that this technology is about to just upend everything we know about labor and value.
It really feels like we are walking a tightrope right now for you guys trying to navigate this between everything is amazing and everything is about to collapse.
Exactly.
And that is exactly what we're going to unpack today. We have a lot to get through.
We do.
First, we're going to break down the historic, record-breaking State of the Union address. And I mean record-breaking in terms of pure endurance.
Oh, absolutely.
We'll get into the tariffs, energy, the return of the big, beautiful bill.
And we really can't ignore the tech sector either. There's been this fascinating shift in just the last week from pure fear to what some are now calling a relief rally.
Right, the AI ghost trade.
Exactly. We need to understand why the narrative is suddenly shifting from AI is going to replace us to AI is going to orchestrate us.
Plus, we have the chip wars.
Oh, the chip wars are huge right now.
There's a deal on the table between Meta and AMD that is so complex, so strategic, it completely changes the incentive structure of the semiconductor market.
If you only take away one thing from this deep dive today, make it that Meta-AMD deal.
Definitely.
Yeah.
Because it involves a financial instrument that is basically a weaponized stock option.
That's a great way to put it.
And finally, we will touch on the rise of halo assets. Why, in a world of digital disruption, the safest place for your money is suddenly a physical copper mine or a luxury handbag.
It's the revenge of the real world.
So grab your coffee or your anxiety medication, whichever is closer for you, and let's dive in.
Let's do it.
Okay, let's start with the main event, the State of the Union. And we aren't just talking about the content here. We have to talk about the endurance test.
It was a marathon.
Longest State of the Union in U.S. history.
108 minutes, almost 2 hours of speaking.
Yeah, and the tone was undeniable. It wasn't a humble update. It was a victory lap.
It was very fiery, very celebratory. I mean, the opening declaration really set the stage for the whole night.
What was the exact quote from the transcript?
The president said, quote, "Our country is back. We are bigger, stronger, richer than before. This is the American Golden Age, and we are not going back."
The American Golden Age. That is a heavy label to put on the current moment, especially when you talk to regular people who might not feel like they're living in El Dorado right now.
Right. But he didn't just say it. He threw a massive barrage of metrics at the audience to back it up.
And I want to dig into these claims for you listening because they paint a very specific picture of the economy. I'm curious how much of this is structural reality versus, political theater.
Well, the central theme running through all of it was affordability.
Affordability.
That is the buzzword. The administration knows that is exactly what people feel in their wallets every day. So the claims were targeted directly at that. He mentioned that prices are precipitating.
Precipitating. That's an interesting word choice. It implies they are falling rapidly, like rain. But are they actually falling like that?
Well, the claim is that they are falling, not just stabilizing.
Because inflation coming down is one thing. That just means prices are rising slower.
Exactly. Actual deflation, where prices go back to where they were 3 years ago, that is much harder to achieve. But he coupled that claim with the jobs market.
Right.
The claim is that there are more jobs now than at any point in history.
And he went further into specific sectors, too.
Yeah.
Pharmaceutical prices are down.
Yeah.
Oil production is at maximum capacity.
Yes. And for the housing market, which has just been a nightmare for anyone under 40, he cited mortgage rates hitting 4-year lows.
That mortgage rate stat is the one that is definitely designed to catch ears. If you can unlock the housing market, you unlock a lot of economic sentiment.
Absolutely. But there was also a really interesting point made about technology and energy costs that we need to highlight.
Yeah, I caught that in the transcript. We usually hear about how much energy AI consumes, right? How data centers are sucking the grid dry. But the speech flipped that script entirely.
It really did.
The argument was that technology is actually being used to offset electricity costs.
Hmm.
How does that even work in practice?
So, the administration's claim is that the tech sector is going to build its own energy plants to support its massive growth.
Rather than draining the existing public grid.
Exactly. It's a way of framing the AI boom as a solution to the energy crisis rather than the cause of it.
Like, we aren't using your electricity, we're building new electricity.
Right. Now, whether that pans out in physical reality is a massive logistical question. Permitting alone takes years, but politically, it is a very smart pivot.
And amidst all this talk of golden ages and energy solutions, we saw the relaunch of a very specific piece of legislation.
The big, beautiful bill.
It's back.
It is back! And alongside that, we had some interesting personnel announcements in the speech. J.D. Vance has been appointed as the anti-fraud czar.
Anti-fraud czar. That is quite a title.
It is, and it pairs with a proposal that actually got bipartisan applause in the chamber, which is pretty rare these days.
Oh, the insider trading ban.
Yes. The president called for a strict law to ban insider trading in Congress.
You know, the bar is low when politicians shouldn't trade stocks on inside info is a standing ovation line.
Yeah, exactly.
But hey, I'll take it. But let's pivot to the elephant in the room. The policy shift that has economists sweating and cheering at the exact same time. Tariffs.
This is the big structural shift we need to look at. The 10% tariffs have officially entered into force.
Right.
Now, the administration acknowledges this is complex, but the key takeaway from the speech was the bold assertion that they do not need congressional approval for this.
That is a massive consolidation of economic power.
Mm.
But let's get into the weeds here, because the long-term vision he proposed in the speech was, well, it sounded like economic fiction to me at first read.
The income tax replacement.
Yes. The president said that in an ideal world, tariffs should eventually replace income tax.
That is a staggering proposition. We really have to pause on that.
Yeah, let's pause. Replacing income tax with tariffs. Is that even mathematically possible? I mean, income tax brings in trillions of dollars. Can you really fund the U.S. military, Medicare, and everything else just by taxing imported toasters and cars?
If you look at the raw math today, no, not even close.
Right.
It would require tariffs so extraordinarily high they would likely strangle international trade entirely. But the proposal isn't just about the math. It's about philosophy.
How so?
It's a return to a pre-1913 economic model.
Oh, before the IRS.
Exactly. Before 1913, the U.S. government was largely funded by tariffs and excise taxes. There was no federal income tax.
So he literally wants to rewind the clock over 100 years.
That's the stated goal. The idea is to shift the tax burden from the earner, you and me, working our jobs, to the importer and the consumer of foreign goods.
Okay, play this out for me then. If this actually happened, big if, what does that actually do to the economy?
It completely changes behavior. That's the goal. If you tax imports heavily, you discourage them.
So we buy domestic.
Right. And if you remove income tax, you theoretically hypercharge domestic consumption and investment because people keep their entire paycheck.
Right.
The argument is that the domestic economy grows so much faster that it offsets the massive loss of tax revenue. It is a massive bet on American self-sufficiency.
It sounds like a high-stakes gamble.
It is.
And it seems like the Supreme Court is involved in this dance as well.
Right.
There was a moment described in the source material where the president was shaking hands with the Supreme Court justices as he walked in.
Right, but then during the speech, he referred to a recent decision on tariffs as very unfortunate.
Very unfortunate.
Yes, it shows that there is still serious institutional friction there regarding executive power over trade.
But despite that friction, the president insisted that the good news is that all countries want to honor the agreements.
It's a very optimistic view of international trade relations,
Assuming that other nations will just accept these blanket tariffs without any retaliation.
which historically is rare.
Speaking of other nations, let's look at the foreign policy section of the speech. The claim was made that they have ended 8 wars. That is a bold number.
It is very bold. And the specific examples given were fascinating. Regarding Iran, the president said, quote, "They want a deal."
But he added a caveat.
He did. He said he hasn't heard the magic words yet.
And those magic words are,
We will never have a nuclear weapon. Until
Hmm.
those words are said, he claims there will be no deal. But then contrast that with how he talked about Venezuela.
oh, this is my favorite phrase of the entire speech. He called Venezuela an amendable friend.
An amendable friend. Yeah.
What does that even mean in diplomatic terms? Does that just speak for We don't like you, but we can use you.
Precisely. And why are they amendable? Because according to the speech, they are providing 80 million barrels of oil.
So political ideology goes right out the window when there are 80 million barrels of oil on the table.
Pure pragmatism. It highlights a very transactional approach to foreign policy right now. If you have what we need, which is energy, we can be friends. If you don't, or if you threaten us, you get tariffs or sanctions.
Now, as you know, we can't just take the Golden Age narrative at face value. We're impartial here, so we have to look at the rebuttal.
Of course.
The sources mentioned that while the president was speaking, the New York Times was actively raising some red flags.
Yes, the fact-checkers were very busy that night. There were concerns raised about the strict accuracy of some of those record-breaking economic claims.
And the official Democratic response came from Abigail Spanberger, the governor of Virginia.
Right.
What was her counterargument to the Golden Age?
She directly pierced that affordability narrative. Her argument was that for millions of regular Americans, economic conditions simply haven't improved.
The vibe on the street versus the stock market.
Exactly. The Golden Age might be happening for your retirement portfolio, but not when you go to the supermarket. She also attacked the foreign policy stance heavily, arguing that America is actually ceding economic power to China and kneeling to Russia in the current global setup.
So we have two completely different realities being presented to the listener. One where America is back and completely dominant, and one where it's retreating and struggling.
A tale of two countries.
But here's the thing that really struck me from the data. The market reaction.
Oh, yes.
You would think with all this massive political drama, 10% tariffs, overhauling the entire tax code, the markets would be incredibly volatile.
But they were surprisingly muted, almost bored by it.
Why is that? Are the financial markets just ignoring the president?
It suggests that the markets have learned to filter out the political theater.
They price it in.
Exactly. They are shrugging off the fiery rhetoric to focus on the cold, hard financials. They are looking at corporate earnings, at interest rates, and mostly at data centers. The speech was a show, but the market is watching the corporate balance sheets. And right now, those balance sheets are telling a story about technology that is overshadowing almost everything happening in Washington.
Which brings us perfectly to our next section, the relief rally.
Yes. We really need to talk about this massive mood swing in the tech sector.
It really was a mood swing, wasn't it? For months now, we have been hearing about the AI scare trade.
Constantly.
This prevailing idea that AI is going to come in, eat everyone's lunch, and traditional software companies are just going to go extinct.
That was the absolute consensus fear. The narrative was pure obsolescence.
Right, like why would a company buy a massive Salesforce package or Adobe suite if an AI agent can just do that specific work for free?
Exactly. Investors were terrified that these massive software giants were basically walking dead legacy code.
But that sentiment has fundamentally shifted in just the last week. We are moving from the AI scare trade to what the analysts are calling the AI ghost trade.
The AI ghost trade, meaning the fear was a phantom.
Right. The idea is that the fear of total replacement was completely exaggerated. And the catalyst for this shift, according to the sources, was a live stream event from Anthropic.
Anthropic. They are the makers of Claude, one of the primary competitors to OpenAI and ChatGPT.
Right. So what did Anthropic do on this live stream that calmed the entire stock market down?
They announced 10 new cloud plugins. And these plugins were targeted at very specific high-value corporate sectors: investment banking, wealth management, and human resources.
Okay, but hold on. Play devil's advocate for me here. If I am an investment banker or an HR manager listening to this, shouldn't that announcement terrify me?
You'd think so?
Shouldn't I be thinking, great, Anthropic just built a plugin that does my job? Why did the market react positively to that?
Because of one very crucial word that Anthropic kept using: partnership.
Partnership.
Anthropic didn't announce they were replacing these legacy software systems of these industries. They announced they were partnering with them.
So they're integrating.
Exactly. It signaled to Wall Street that while obsolescence is always a long-term risk, the immediate future isn't about total replacement. It's about integration.
It's not AI instead of software. It's AI inside of software.
Precisely. Deutsche Bank actually released a note right after the event that summed it up perfectly.
What do they say?
They said they now have a much stronger conviction that AI models won't replace incumbent software companies. Instead, AI will act as an orchestration layer on top of them.
An orchestration layer. I really like that image. It's like the conductor of an orchestra.
That's a great analogy.
The AI is the conductor waving the baton, but you still need the violinists and the cellists, which are the traditional software programs, to actually make the noise.
Exactly. The AI just tells them when to play. And the market absolutely loved that narrative. We saw a genuine massive bounce across the board.
Give us the numbers.
The broad ETF for the software sector was up 2% immediately. FactSet jumped 6%, which was its best rebound in 10 months. Thomson Reuters was up 11%. Salesforce was up 4.5%.
Those are significant moves for mega-cap companies. Yeah. It sounds like the market collectively realized, oh, wait, Salesforce isn't going to die tomorrow. It's just going to get a smarter interface.
Exactly. It shows that institutional investors are aggressively repricing the risk. JP Morgan weighed in as well on this.
What was their take?
They wrote, "Disruption risk exists, but catastrophism seems excessive."
Catastrophism seems excessive.
Yeah.
That sounds like a very polite investment banker way of saying, everyone, please calm down. You're being completely hysterical.
Essentially, yes. Take a deep breath. Jefferies International also came out and said they are actively reducing their risk exposure to obsolescence.
Meaning they are pulling back their bets against the legacy software companies.
Right. They are betting that the panic is officially cooling off.
So the traditional software companies are breathing a massive sigh of relief. But there is one company that doesn't need a relief rally because, frankly, it never stopped rallying.
Oh, the king of the chip wars.
We have to talk about NVIDIA.
NVIDIA, the absolute sun around which the entire S&P 500 currently orbits.
It really feels that way. Every source we looked at framed their upcoming earnings report as the single most critical event for the entire market.
More important than the jobs report, more important than inflation data.
But reading through the analyst notes, I keep seeing this term, the whisper number.
Yes.
Unpack that for us. What exactly is the whisper number?
So the whisper number is the informal, unofficial expectation. It's what the analysts are actually saying to each other at the bar or in their private group chats versus what they are legally allowed to write in their official published reports.
Okay, so the official estimate is the safe guess.
Right. The official published number might be high, but the whisper number is usually even higher. It's the real expectation.
So NVIDIA doesn't just have to beat the official Wall Street estimates to succeed.
No. To keep this massive stock price moving upward, they have to beat the whisper number, which is incredibly difficult.
That is a wildly high bar. It sounds like a game where the goalposts move while the ball is in the air.
It is, but so far, they've been clearing it. And looking at their underlying financials, it is just staggering. Data centers now make up 90% of their total revenue.
90%?
Yes. They have effectively pivoted the entire trillion-dollar company to service this one massive, insatiable need for AI compute.
And the margins. The sources highlighted their gross margin guidance is 75%.
75%.
Okay, for people listening who don't read corporate balance sheets for fun on the weekends, explain why a 75% gross margin on a physical product is basically insane.
Because hardware is usually a brutal grind.
Right.
You make a smartphone, you make a car, you have massive physical supply chain costs. Your margins are thin. Maybe 20%, 30% if you are incredibly efficient. Right. 75% means for every single dollar of chips they sell, they keep 75 cents as gross profit.
That is software-level margins on a piece of physical silicon.
Exactly. It shows immense, almost unprecedented pricing power. They can essentially charge whatever they want, and these trillion-dollar tech companies will pay it because they literally have no other choice right now.
But there's a bear case. We have to look at the other side of the trade.
We do.
Cantor Fitzgerald released a note. They maintained an outperform rating on the stock, but they actively highlighted the big structural risk. The fear is that CapEx has peaked.
Capital expenditure.
Right. This is the idea that companies like Microsoft, Google, Meta, they've been spending tens of billions of dollars building these massive data centers. But eventually they have to stop, right?
That is the fear. Are these companies building too many data centers? Too fast, ahead of actual consumer demand for AI?
Because if that capital spending slows down, Even a little bit. NVIDIA has nowhere to go but down.
Exactly. If the gold miners stop buying the shovels, the shovel maker's stock crashes. It's that simple.
And the competition is finally heating up, too. It's not just NVIDIA anymore. We have completely new generations of chips coming out. NVIDIA has their Blackwell line and the upcoming Vera Rubin architecture.
But there are a lot of other players entering the arena now, and the naming convention is getting quite funny, honestly.
Oh, right. Grok versus Grok. Help us distinguish those before someone listening buys the wrong stock symbol.
So you have Grok, spelled with a Q at the end.
Yeah.
And you have Elon Musk's AI model, Grok, spelled with a K.
Got it. So what does Grok with a Q do?
Grok with a Q is a hardware company. They make physical chips, and they specialize in inference chips, whereas NVIDIA completely dominates training chips.
Okay, we need to stop there for a second. Training versus inference. This distinction came up in almost every technical source we read. Break it down like I'm 5 years old.
Sure. Think of training as going to university. That is the AI going to school. It's reading the entire internet, it's crunching trillions of data points, it's learning the structure of human language. It takes massive, massive brute force computing power and months of time.
And that is where NVIDIA makes its money right now.
Exactly. NVIDIA chips are the university.
Okay, so if training is the education, what is inference?
Inference is the day job. The AI has graduated. It knows the language.
Right.
Now, when you, the user, log on and ask ChatGPT to write a poem, or you ask a customer service bot to check your refund status, the AI uses what it learned to generate an answer. That process is inference.
So it's applying the knowledge.
Right. It's computationally much lighter, it's faster, but it happens billions of times a day across the globe.
And that is where the hardware market is shifting.
That's the big bet. We are moving from a world where we are primarily building the brains, which is training, to a world where we are actively using the brains, which is inference.
And companies like Grok and AMD are looking at that and saying, what?
They are saying, we don't need to be better at teaching the AI than NVIDIA. We just need to be faster, cheaper, and more power efficient at running it.
Running the day job.
Exactly.
And that distinction, training versus inference, is absolutely crucial for this next story. Because this is what we consider the deep dive nugget of the week.
The Meta and AMD deal.
Yes, this is a fascinating piece of corporate strategy. It is a massive, complex deal that the analysts think might become the new gold standard for how these hardware partnerships are done.
It really is brilliant.
So break it down for us. What exactly did Meta and AMD agree to?
Meta has entered into a multi-year agreement to buy custom AMD chips, specifically designed for inference.
Okay.
And the scale of this purchase is huge. They project these chips will eventually power 6 gigawatts of compute.
6 gigawatts. Or I hear
Yeah.
that and I just think of Back to the Future. What does 6 gigawatts actually mean in real-world terms?
Well, to give you a physical sense of scale, 1 gigawatt of power can run about 700,000 average homes. So we are talking about drawing enough continuous electrical power for over 4 million homes, just for Meta's inference chips.
That is mind-boggling scale.
Ugh.
But the truly interesting part of this deal isn't just the sheer number of chips or the electricity. It's the financial structure behind it. The kicker.
The warrant.
Right. In exchange for signing this massive contract, Meta gets a warrant to buy AMD stock.
Which completely changes the dynamic.
So explain what a warrant is for those who don't spend their days trading options. Is it like a corporate coupon?
Think of it as a loyalty card on absolute steroids. A warrant is basically a financial option that gives Meta the right to buy AMD stock at a specific, predetermined price in the future.
Okay, what are the actual terms here?
Meta has the right to buy up to 160 million shares of AMD. That represents roughly 10% of the entire company.
10% of AMD.
Right. But they can only execute this warrant if the stock hits $600 a share.
Okay, and where is AMD stock trading right now?
Around $200.
So let me get this sequence straight, make sure I'm following. Meta buys custom chips from AMD.
Yes.
That gives AMD a massive locked-in revenue stream. AMD's revenue goes up, so their stock price naturally goes up.
Correct.
And if the stock price goes up enough, if it basically triples from 200 to 600, Meta gets to buy a huge chunk of the company at a fixed price and essentially make a fortune on the equity.
Exactly. It completely aligns their corporate incentives. Meta is now effectively financially incentivized to pump AMD's stock price.
They actively want their supplier to succeed and grow as fast as possible.
Right. It's a way for AMD to acquire a massive anchor customer, but they are dressing it up as a strategic partnership. Mark Zuckerberg basically becomes AMD's biggest hype man.
Because if he hypes them up, he makes billions. It's brilliant. AMD is basically paying its biggest customers with its own equity to help them break NVIDIA's monopoly.
Help us kill the king and we'll give you 10% of the kingdom.
That is exactly the strategy.
And it's not the first time we've seen this exact playbook. It mirrors a previous deal AMD did with OpenAI, which, interestingly, also involved a 10% warrant.
Wow. So now you have OpenAI and Meta, literally two of the biggest, most powerful AI developers on Earth, both financially motivated to see AMD win.
That is a very serious structural threat to NVIDIA's dominance over the next 5 years.
It's like they are building an alliance. The enemy of my enemy is my friend, and if my friend's stock goes to 600, I get incredibly rich.
Precisely. The incentives are locked in.
Now, while this massive digital war is raging over data centers and gigawatts in silicon, there is another trade emerging in the background that goes in the complete opposite direction. We need to talk about the halo trade.
The flight to physical reality.
Yes. So we have this absolute blood sport happening in the digital cloud, right? NVIDIA versus AMD, training versus inference, Anthropic versus OpenAI. But there is a whole cohort of institutional investors who are looking at this digital chaos and saying, you know what? No thanks. I want something I can actually drop on my foot.
Right. They want tangible value. This is the halo trade.
Halo. H-A-L-O. Heavy asset, low obsolescence.
It is the perfect hedge against the AI boom.
How so?
Well, the investment thesis goes like this. If you genuinely believe that AI is going to disrupt everything that happens on a computer screen, right? If it can write software code, create commercial images, analyze legal data, do HR.
It eats the digital world.
Exactly. Then you should actively put your capital into the physical world that AI simply cannot simulate or replace.
Because you can't prompt an AI chatbot to build a suspension bridge.
Exactly.
Yeah.
You can't prompt an AI to dig a ton of copper out of the ground in Chile. So the halo assets are heavy physical things. Factories, electrical grids, physical infrastructure, commodity mines.
The revenge of the real world.
It is.
But looking at the source list for these halo assets, there is one tech company that is being included in this category which initially surprised me.
Apple.
Yes, the Apple exception.
Why is Apple, a company that makes software and digital services, considered a halo asset alongside a copper mine? Because of the massive scale of their hardware.
The devices.
Right. Apple has roughly 2.5 billion physical devices sitting in people's pockets and on their desks right now.
2.5 billion active screens.
Exactly. So the thesis is, even if AI radically changes all the software we use, even if we stop using Google search and only use AI agents, you still need the physical glass screen to look at it.
You need the container.
Apple is the physical container for the AI applications. It's the ultimate hardware gateway.
And speaking of physical presence, there was a news item in the sources that Apple is going to start producing Mac Minis in the USA.
Yes. That completely reinforces that heavy asset domestic manufacturing narrative we talked about with the tariffs.
It's interesting how made in USA manufacturing is suddenly becoming a financial shield against AI disruption. Now, Goldman Sachs has actually taken this halo concept and applied it specifically to Europe.
They did. They created a custom basket of high capital intensity European stocks.
Meaning companies that require a ton of physical equipment and money to operate.
Right. And this specific basket of stocks is outperforming the wider European market significantly.
What are the numbers?
It's up 11% year to date. That is roughly double the return of the wider stock market average.
Okay, so who exactly is in this Goldman basket? What makes the cut?
It's a mix of real European heavy hitters. You have ASML in there.
Okay, because even advanced AI chips need massive, complex physical machines to actually print them.
Exactly. You have Safran and Airbus. Because no matter how smart AI gets, we still physically need planes to fly us from London to New York.
Right.
Air Liquide is in there for industrial gases. And then my absolute favorite inclusion on the list, LVMH.
LVMH, Louis Vuitton, Moet Hennessy.
Yes.
Okay, wait. Why is a luxury handbag conglomerate a heavy asset, low obsolescence halo stock?
Think about the psychology of it. AI can instantly generate a photorealistic picture of a beautiful handbag.
Sure, Midjourney can do that in 2 seconds.
Right. AI can even analyze trends and design a structurally perfect handbag. But what AI absolutely cannot do is replicate the social status of a human being actually carrying a physical Louis Vuitton bag down the street.
Ah, that is fascinating. You can't wear a digital deepfake to a dinner party.
Exactly. Luxury goods are incredibly safe from AI disruption because their core value is inextricably tied to their physical scarcity, human craftsmanship, and centuries of brand heritage.
Things AI literally has a hard time disrupting.
Right. You are buying the human history, not just the utility of a bag.
So we have the U.S. looking at a self-proclaimed golden age of these halo assets. But what is happening in the rest of the world right now? Let's take a quick tour of the global markets based on the data we have.
Well, if you look at Asia right now, it is an absolute boom, breaking records across the board.
Japan is on an absolute tear.
The Nikkei index is hitting historic records. It's nearing 59,000 points.
Unbelievable run.
And the yen is actually recovering slightly, too, after some persistent rumors that the premier formally opposes any further interest rate hikes.
But the real story in Asia might be South Korea.
The Kospi index.
Yes, the numbers here are wild. The Kospi is up 44% year to date. It's crossing the 6,000-point threshold.
44%.
That is crypto-level growth for a major national stock index. What is driving that kind of massive volume?
It comes down to two absolute giants in their economy, SK Hynix and Samsung.
Chips again?
It always comes back to chips.
Yeah.
They are the primary manufacturers of the high bandwidth memory chips that are absolutely essential for running AI models.
But you have to ask, as an analyst looking at a 44% jump in a few months, is there excessive euphoria building here?
That is the multi-billion-dollar question.
Right.
When does a golden age structurally transform into a classic bubble?
Right.
A lot of cautious investors are looking at those Kospi charts and getting a little bit of vertigo. But we are seeing similar record-breaking runs in Shanghai and Taiwan as well. The whole region is being lifted by this massive tech tide.
Now, before we wrap up our tour of 2026, we have to touch on a corporate drama that honestly reads like a television script. The media war.
Ah, yes. Warner Bros. Discovery versus Paramount.
The massive bidding war that seemingly never ends. According to the reports, Warner Bros. Discovery has stepped up and offered a newly improved bid.
But they are up against a massive rival offer.
Netflix.
Yes. Netflix has an $83 billion offer on the table for Paramount.
$83 billion. But Paramount has a poison pill defense in their contracts, right? Let's talk about that.
They do, and the financial details of this poison pill are really nasty for whoever tries to buy them. They aggressively raise the termination fee.
To what?
$7 billion. $7 billion. Meaning if Warner or Netflix signs the deal, but government antitrust regulators block it from happening, the buyer just has to pay Paramount $7 billion for nothing.
Exactly. It's a massive, steep price for failure.
And there are ongoing penalty payments too, right?
Yes. Paramount structured it so the acquiring company has to pay shareholders 5 cents per share for every single quarter that regulatory approval is delayed.
Wow. So it's essentially a ticking financial clock. It's designed to force a very quick, committed decision.
Buy us now, push it through Washington quickly, or pay the price. It's incredibly high-stakes corporate poker.
And just quickly, hitting some European corporate movers from the transcripts, Telecom Italia.
That is a huge turnaround story. The stock has essentially doubled in 12 months.
Really?
Yes, and they are officially proposing a share buyback, which is their first shareholder remuneration since 2022.
Nice.
Plus, their core debt is dropping below $6.9 billion. It's a very strong sign of financial health returning to the legacy European telecom sector. And what about the banking sector? Monte dei Paschi was mentioned.
MPS, yes. A bit of governance tension brewing there. The Italian Treasury currently owns 4.9% of the bank, but they've explicitly stated they won't interfere in the upcoming board list selection.
Interesting.
And there are strong market rumors floating around of Corrado Passera emerging as a potential candidate. It's definitely one to watch closely for European market watchers.
And finally, Stripe, the massive payments processor.
A massive tender offer just went through, valuing the entire company at $159 billion.
159.
Which is up 70%.
Yeah.
And the rumor mill in Silicon Valley is churning incredibly hard that they might use that valuation to go out and buy PayPal.
Stripe buying PayPal. That would literally be the modern disruptor swallowing the original incumbent.
It would be a completely defining moment for the future of global fintech.
Okay, so we've covered an immense amount of ground today. From the Marathon State of the Union and the return to tariffs to AI orchestration, the meta warrant, and the halo trade.
It's a lot to process.
So synthesizing all of this for you listening, What does this all actually mean?
If we zoom out and look at the whole board, the core mission of this deep dive was to decode the current state of the world economy. And looking at all these disparate sources, I think the grand theme here is bifurcation.
Bifurcation, a splitting in two.
Yes. We are watching the global economy physically split. On one side, you have infinite digital scalability. AI, software agents, the ghost trade, inference chips.
It's ethereal, it's frictionless, it's incredibly fast.
Exactly. And on the exact opposite side.
Your revenge of the real.
Right. Halo assets, physical commodities, global tariffs, gigawatts of electricity, domestic manufacturing, the golden age of physically making things and digging things out of the ground.
It really feels like the entire economy is desperately trying to decide what is ultimately more valuable right now, the code or the copper.
That is the fundamental tension of 2026. And I have a provocative thought to leave you with, connecting these two halves.
Yeah.
Think about the two biggest trends we just discussed. If the administration's policy dream actually comes true, and import tariffs eventually replace human income tax.
Okay.
And simultaneously, if the tech sector's ultimate dream comes true, and AI eventually replaces traditional human software labor and services,
Right.
are we rapidly moving toward an economy where immense wealth and value are only generated by owning things? Owning inference chips, owning oil wells, owning luxury heritage brands.
Rather than doing things.
Exactly. An economy entirely based on capital ownership because human labor has been completely devalued by AI and tax structures.
Wow. An economy of ownership, not labor.
Yeah.
That is deeply unsettling, but absolutely something to chew on.
It's the logical endpoint of these two massive trends colliding.
Well, on that cheerful, mildly existential note, we will wrap it up for today. Thank you for joining us as we sorted through all this.
It was a pleasure.
We will see you all in the next deep dive. Keep your eyes on the physical world.